investor. We're talking real money.
Hey, everybody. Welcome to the Talkin' Real Money podcast. We're out here riding a financial range in search of a better way to invest. Just like all of Wall Street and Insurance Street. There should be an Insurance Street. What is the Insurance Street? Used to be Hartford, Connecticut, but it's not that anymore. We need an Insurance Street so we can make fun of them, too.
But doesn't the guy in Omaha own a big insurance company? Couldn't we make it Omaha Avenue or something?
No. Okay. I'm sorry, because Peyton Manning has a trademark on the use of the word Omaha.
Omaha. Yeah. Okay. Yeah.
Anyway, Don here, Tom there, talking real money because it's important. We know it's important. And one of the things we also know that is important to you, wait, your level's louder than mine now. Bringing mine back up. One of the things we know that's important to you is the safety of your assets. We know it because you're always saying, well, I want to make a lot of money, but I want to keep it safe. Well, Wall Street and Insurance Street, they're listening to you because they want to give you what you want, even if it's not good for you. And the latest attempt to give you what you want is a new ETF, Tom. I love this thing. That was your cue.
Oh, I was waiting for you to and then say what.
When I say Tom. Oh, that is okay. Remember?
Do it again. All right.
Is this new ETF, Tom?
And it's Wall Street's way of giving you chocolate cake with every meal, but not putting on 1 pound. I love this. This is 100% downside protection. 100%
of the S&P 500. Yeah,
it's called a buffer ETF. The ticker is TJUL. This is an exchange-traded fund that tracks the S&P 500, but the 100% buffer. What the heck does that? I don't even know what that means.
Well, let me read you,
please,
from the Innovator ETFs, the people who created this. The Innovator Equity Defined Protection ETF seeks to track the return. I love the way they say this. Track the return of the SPDR S&P 500 ETF Trust. That's the SPDR, SPY.
Yep.
Up to a predetermined cap, while buffering investors against 100% of the losses over the outcome period before. There's a little qualifier in there. Before fees and expenses.
Which are how much? How expensive is this?
0.8%.
Okay.
No. 0.8%.
Fairly expensive.
So their cap, they cannot make more than 16% per year. It's the best year. And they say they can't lose in any year. However, it's interesting to look at their most recent performance and see that they're actually down for the few days they've been in business.
Yeah, I was going to say, they haven't been around very long. I mean,
no, they've been around for a few days.
Okay.
But this thing is, to give this kind of a weird guarantee requires a lot of alchemy.
Yeah, please explain how they do this. Please tell us how they do this.
Well, one, they don't own any equities at all. They do not own the S&P 500. They don't own anything. This is a pure betting fund because options are not, you don't own anything with an option. You don't own anything with an option until you exercise that option and either sell stock that you have or buy stock that you don't have. And now I have to explain options, don't I?
You think this was your idea. You're going to spend 20 minutes explaining this entire thing because I don't know what this is all about.
Well, one, it uses just options. And they go long and short the market. And long means you are betting on the upside.
What is an option, though? What does that mean?
I'm getting to that. Okay. You're betting on the upside or the downside. And there are several ways to bet upside or downside on the options market. The simplest way If you expect the stock market to go up, you expect the SPY to go up, is you buy an SPY call option. That means you pay money for an option that can be converted into the SPY at a future date at a particular price. You pay a premium over what the ETF is worth because you're betting on the future. You're using other people's money. In other words, you're kind of leveraging because one option gives you the right to buy 100 shares of the ETF, and they sell for just a couple of bucks. But to give you downside protection, you either have to sell a call.
Yeah, I was going to say, wait a minute, you got me going again here.
Or buy a put. A put option gives you the right within a certain amount of time to take stock that you own and put it back to the person who created the put.
Okay, so for those of us who only understand English, can you provide it in that language?
Yeah, here's what they're doing. They're taking a portion of their money and betting on options that say the market will go up.
So some of the money is saying stocks are going higher.
It's about 10%.
Okay.
That's on the higher side.
Okay.
Okay?
Yeah.
Then the other 90, 80, or 90% of the options are betting on the downside. They're betting that they're there to protect you in case the market goes down.
Which it on a daily basis, it's about an even split between up or down.
Right, but they're not doing it on a daily basis. They're doing it over about a 2-year period.
Okay.
So they're betting slightly longer term. But the key is this is 100% betting. This is a gambling fund, but it is gambling in the opposite way that most people gamble. Most people gamble to get rich, to make a lot of money.
This one is to save you.
And here's what's fascinating about it. Their goal over the long term, this is their goal. Their goal is to make a little more money than cash.
That's their goal?
That's their goal.
Can't you just do that with a CD or something?
Yes, actually, see, if you get the higher yielding CDs, you're probably going to do as well as this fund does without the complexity, the confusion, and without making a lot of other people rich.
Now, wait, I think you're going to say confusion, complex, and cost, because
it's very expensive.
1% in today's world is quite a bit.
Yeah, I mean, typical ETFs, relatively passive or lightly semi-managed, they're less than a quarter of a percentage point.
I don't blame Innovator. I blame Bloomberg for making this into a story. I mean, the headline is astounding. New ETF offers 100% downside protection. Mm-hmm. I mean, everybody's going to check that box, right?
Mm-hmm.
Sounds simple.
Sounds great. Except the reality is your average returns, again, they're saying that, let's say the market does really, really well. We have one of those years, and we've had these years, where the market goes up 30 or 40% in a year, right?
Yeah, it happens.
Well, we've had it even more than that. You're capped at 16% in those great years.
That sounds like a annuity of some kind.
Doesn't this sound a lot like an indexed annuity?
It does. Like you get part of the return, but you get all that protection, so you feel good about when things are going the wrong way.
That's the reason why they created it. Because why should just those indexed annuity guys make all the money and have all the fun? When, the ETF folks could do the same thing, and they can do it actually, here's the thing. They're doing the same thing, but they're doing it cheaper than the overpriced equity annuities are doing it.
Or you could do something like having a split between stocks that go up and bonds that are more stable.
And to be more stable.
And
let's go. Have been. Thank you. Past tense.
And pay a lot less than 0.8% a year. Now, I rarely, when I'm looking at these things, do I turn to the Securities and Exchange Commission, because they're kind of usually, no offense, behind. They'll be coming along in a few years later saying.
They also tend to be a little agnostic on this kind of stuff. As long as everything is disclosed, which it is, by the way. I've read through the prospectus, the fact sheets, the guides, all the stuff. They're very clear about all the dangers involved. You're not going to read them, because you don't read the stuff. I know you. You don't read prospectuses.
You're speaking to both me and everyone else.
Everyone listening.
Here's their joint statement regarding complex financial products and retail investors. I love this. This is from the Securities and Exchange Commission. We believe that these complex products may present investor protection issues, particularly for retail investors who may not fully appreciate the particular characteristics or risk of such investments. They go on. We're also concerned that retail investors and, in certain cases, financial professionals may not fully appreciate how these types of products operate.
That means that the people who are selling them to you don't even know how they work.
We've seen this in the insurance industry.
Well, look at Tom. Tom's going, what?
Don't know.
Now, see, the difference between the two of us is that I've had a Series 7, which requires a lot of option training, so I kind of get options. Tom, in the 65, there's no option training.
No, because it's all mutual funds.
Yeah, it's all mutual funds. Yeah. Here's the interesting thing. I'm looking at their fact sheet from as of 8/16. Oh, that's today.
Yeah.
The fund has been around since 7/17, so it's 1 month old, ladies and gentlemen. And how have they done so far? The return to date has been negative 0.7%. And you notice how that neatly dovetails in with their expense ratio, because they said they want to protect you from downside minus fees. So they're saying basically your worst case year would be an 0.8% loss. But I'm curious. I'm going to keep an eye on this because I want to see if they actually pull that off.
Now, for you listening, the reason I wouldn't suggest you use this fund is I do believe that when you invest, you should understand the strategy. And I don't think most people are going to understand that. Number two, I do also believe that in a general sense, your investment should be relatively simple. We know the more complex things are, the more things can go wrong, the more things can happen that you thought, well, that could never happen. Yeah, it could. And that's why we give you like index ETFs, why when we manage money, there's some complexity, but no way near this. This is off the charts in terms of that sort of complexity. So this would not be a fund I would recommend to you.
The other thing I keep coming back to is the brilliant, simple wisdom of a Nobel Prizer. He's a prizer. He surprised me with his prizer. With Nobel Prizer Harry Markowitz. Harry Markowitz once said, investing should be like watching grass grow or paint dry.
That's boring.
It should be dull and boring.
Oh, okay.
And the problem is Bloomberg, Money Magazine, Forbes, Kiplinger's, Wall Street Journal, Barron's, the list goes on and on. They can't stand boring because boring does not bring in readers. CNBC hates it because it doesn't bring in viewers. Boring is boring. So if you want boring, you'll have to listen to boring old shows like ours.
Yeah, sorry. About that. Yeah.
But you want boring. That's what you want. You don't want that other stuff. So to all of you who say, I want the no risk, all the return to the market. I want crypto. I want just the high-tech stuff. I want my AMC theaters and my Bed Bath & Beyond. I want all those crazy things. Well, enjoy yourself, but this is not the place to find them. And you are going to find that every once in a while, the dumb stuff you're doing works right up until it doesn't.
All right, let's go to the questions.
Let's go to the phones. Oh, no nobody's on the phone.
Can't go to the phones. This one comes from Kyle in Texas City, Texas. Didn't we have somebody from Alaska yesterday?
Alaska, and Texas. Right. Wait, that is really deep in the heart of Texas.
There you go. Kyle writes, can you please explain the new rule/law that lets you move $35,000 from a 529 plan to a Roth IRA? Annual limits, 5-year rule, special items.
You can move $35,000
over a lifetime.
Into a Roth IRA.
From a 529.
There you go.
It has to be. No, there's more. I was
kidding.
It has to be in the 529 for 5 years.
5 years.
And you can only do the maximum that you could move into a Roth IRA. You can only take $6,500 a year and move that to the person's Roth, or if they're over the age of 50, which would be weird, $7,500 a year.
Well, unless wait a minute.
Hey, granddad's going back to
529s
college.
didn't exist that long.
No, so it'd be kind of
Well,
weird.
wait a minute though. No, you have to set it up for minors. Never mind. I was trying to think of a loophole, but I can't.
I think this is spectacular. And
I
for
do
people
too.
that have been big savers, I think it's absolutely terrific way to get a young person. If you're over 50 and somebody's moving there, I think it's weird. Anyway, a young person started for saving. So those are the rules, Kyle. Hope all is well in Texas City.
So a little over
Texas.
4 years, and they can have $35,000 sitting in their
What a great start
in
for
their
somebody.
Roth IRA.
Yeah.
And
Wonderful.
we've done the math a couple of times. And if you do that when somebody's like 18 years old
And do nothing else.
and do nothing else,
It's a lot of
it's
money.
At least several six figures.
But don't put it in the TJUL. Might not quite grow.
Well,
as
that
fast.
just means you're going to get the return of cash, basically,
Exactly. Works
with
well.
a lot of complexity.
This one comes from Dave in beautiful Smyrna, Georgia. Question.
Deep in the heart of
rule.
Georgia.
Deep and way deep. 4% rule. I have $1 million in a traditional 401k and about $600,000 in a Roth 401k, planning to use the 4% rule for withdrawals.
Mm-hmm.
Here's the question. How do you adjust the withdrawal rate knowing that one will take taxes and the other won't?
You don't.
Yeah,
You just adjust it for inflation.
Yeah.
You adjust it for inflation, period.
The
It's
tax,
not a matter
no,
of
but you're
the taxes are gonna
conflating.
get
The
paid
tax
anyway.
the tax have nothing to do with the withdrawal.
Right.
At the end of the day.
Nothing.
So you're taking out the 4, you're paying tax on the traditional, and you're not paying it on the Roth. That's
again,
it.
sometimes I think we were given this big brain to overthink things.
Wait, big brain? Where does that start?
Well, no, but compared to the rest of the animals on the planet,
Okay.
look at
my
the size
dog.
of that noggin you have. There's a lot of gray matter in there.
Wish it
Do
was
you
more
see
active.
your dog sitting around going, "Oh man, I
What
wonder,
about those Roth
I
IRA
wonder at
rules?
what rate I should eat my dog food. If I eat it,
that is not a problem.
slowly,
Yeah. Okay.
I'll feel better throughout the day. But if I eat it really fast, I like it more.
That's it. That's all the questions I have. That's a good show, I think. No?
You made it nice and short with that.
All right. I try.
We're under 20 minutes.
Perfect.
Do you have anything else you'd like to add before
No,
I hit
I
this
mean,
button to stop
I always
everything?
want to let people, I always want to let people know that at the end of the day, most of this is personal. Had a lot of meetings this week. This moving part, that moving part, some of which we talk about in the program, some of which we don't. So if you need some help, we offer review.
Really
we
free.
offer help, and it's free, and we don't pitch you anything.
Really free.
And it's easy to do, to set up a meeting.
It's really easy, and it's really free.
And you know what people have been doing lately? This is going to
What?
surprise you.
Calling you on the phone?
Yeah, they call on the phone. You remember that when people dial it?
I know.
Hi, it's Tom. What, really? You pick
Yeah.
up the phone? Yeah, I like talking to people on the phone.
Yeah, and when you call us, we don't have a machine, well, except maybe on the weekends. We
No.
have like real receptionists.
On Saturday, we have a real person.
Well, look at that.
This
Look at us.
800, it's toll free, Don. 800-386-3004.
And here's another question before we go. Why are there still toll-free numbers?
Oh, it's
Is
crazy.
there any reason for toll-free numbers
Thank
to
you.
exist
That's
anymore?
good, because we've had it for a long time. You had it for a long time and then gave it to us. Now we got it.
just the history of 800-386-3004.
That's
for those
going
of
way
you-
back.
That actually goes back to the Don McDonald money letter, which was called
Wow.
Mutual Fundamentals before that. And that was the phone number to subscribe, 800-FUND-004.
So can I just call that number and put my
004.
credit card information in and I'll start getting the newsletter?
No, because now it forwards to you.
Oh, I see. It doesn't work. All right. So,
So-
if you don't want to call 800-386-3004,
Call
you can
Fund
go-
004.
you can go on the interweb to talkingrealmoney.com and click on Meet an Advisor. We'll be happy
Two
to
in a
help.
row. Two
There
in
you
a
go.
row. Ladies and gentlemen,
feeling
we
so much
appreciate
better.
you so much. Thank you so much for being there. Tell your friends, neighbors, and relatives. And if you like what you hear, leave us a review. If you don't like what you hear, why are you listening? Really, why? If you hate us that much, why are you listening?
Some
Don't
people are
listen.
like that. They just want to.
Don't listen if you don't like us. Go listen to some idiot who agrees with you. And that's it. We're out of here. I'm Don. That's Tom. We're talking real money.
We hope
hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?